Global Money Talk on Sampro TV are delighted to have Paul Podolsky with us today. Paul Podolsky is the founder and CIO of Cape Capital, a Connecticut-based hedge fund focused on discretionary global macro investing across global stock, bond, commodity, and currency markets. Prior to starting Cape, Paul spent 15 years at Bridgewater Associates, the world's largest hedge fund, where he was senior portfolio strategist and head of China research. Prior to that, he was a senior FX strategist at Bank Boston and a journalist in Russia for the Wall Street Journal. He is the author of 3 books, one about work and money, one about being a parent, and a fictional thriller. Paul has a bachelor's degree in history and Russian studies from Brown University and a master's in economics from the Fletcher School at Tufts. Paul, welcome to the show. Thanks so much for joining us.
Thanks so much for having me.
So, when I read that you're running a discretionary macro fund, I was like, wow, that's almost like a white stag or a unicorn these days. It seems like everybody's systematic. So just tell us a little bit about discretionary macro and what you look at when when you're making investments in the fund.
Sure. So the core idea of a hedge fund, the word hedge, just comes from being able to provide an investor with a return that's not completely dependent on whether the stock market does well. The vast majority of savings vehicles people use are dependent on the stock market and maybe secondarily on the real estate market. So that's the core idea. It's an idea that really became popular in the first part of the 20th century after the massive stock market crash in the Great Depression. And people experienced just how bad an investment equities, they could be great, but stocks lost 90% in the Depression. And they've had numerous periods of time with terrible, terrible losses. So then people realized, boy, that would be a great thing. It's a question about how to go about doing it. And I would say there's different types of mouse traps that people use. The mouse trap that Ray Dalio used at Bridgewater when I was there, and which we all got a lot of trading was about, is that markets are complex. And so to be able to capture the complexity, you use a series of rules, what he calls being systematic to trade. And that's obviously worked well for Ray. What I did from before when I met Ray and even with my personal money when I was at Bridgewater was what you're saying is discretion. Discretion says that because the data that informs rules by definition is backward looking, you can have an edge by making forward-looking decisions based on things that you think are going to be in the data but haven't yet appeared. So it's a different way of making decisions. And I think that great investing is like great writing. Everybody needs to find their own path. And that's what's worked for me. And so that's what Cape Capital does.
It's interesting. You talked about, seeing data in, looking at data backward looking, but trying to figure out what's going to happen before it happens. And in your Substack, and very cleverly named Letters from Paul, by the way, you wrote that what AI is going to do to jobs isn't in the data yet. And you put in a sort of an interesting bar chart saying how you think it's going to potentially affect jobs in the future. And AI is all the rage. You could probably reasonably argue that much of the recent rally has really been driven by AI. How will AI affect jobs? I mean, the way I look at it is looking, if we dig into the details, the job growth this year, to the extent that we have had it, has almost always been in education and health, which are not necessarily productive for the economy. So how do you think AI will affect jobs? How have you seen it perhaps in running Cape Capital?
I think the simplest answer is that it'll lower wages for most people from where they otherwise would be. Obviously, if you are a cutting edge AI data scientist, you're getting paid a lot of money. But I mean, on average. So if I look at the types of people that used to be required to create analytics versus what's required now, it's a fraction of the people. AI seems to me, it's not quite as extreme, but it's a little bit like introducing tractors to agriculture, where it used to take an enormous amount of people to till the field. Then you get a tractor, and then one person could do the work of many. Now, I'm not pessimist that in the sense that these people, I think, ultimately will find something else to do because we are creative, resilient people. But in the short term, I think what it'll do is reduce wages from otherwise where they would be. And I can see this with Kate. In other words, you're getting people. There's a lot of people that have been disrupted from the tech sector or finance, et cetera. And you're saying, listen, we have something here that we're trying to offer, but we're only going to, work at these price points, and people are willing to work at those price points.
So it would seem that the wages, it's sort of the formerly more higher wage jobs like the analytics, it's going to be mostly affected. But folks like electricians and plumbers are you going to do that yourself? They should probably be largely unaffected.
That's to your point about the health and the education thing, though I will say the whole system is connected. So if people who disproportionately had higher wages, so services professional, if those people experience a slower rate of wage growth, they will pay less for other things. And that's what inflation is. It's basically just the average of all these pricings. And so I think these things can take a while to play out, but that would be one obvious impact. I think the other thing to say about technology is we never know what inventions are going to be made because of the current set of inventions. In other words, if you think about the advent of everybody, carrying these things around, it's completely changed the way that we move through traffic because somebody was able to say, well, wait a minute, if everybody has a phone, this can actually be another company that I will create based on the fact that everybody's carrying the phones. I was very slow to realize this. When people first came out with cell phones, I was like, I don't like talking on the telephone to begin with. The idea that I'm going to carry one in my pocket is really silly. And I was obviously completely wrong. So technology has an element of unpredictability to it. So I think the most obvious thing with AI is it'll have an impact on wages and overall economic growth that people, when the electrician quotes them a price for fixing the thing, they might say, well, you know what, I'm not feeling right now that I want to do that job. And ultimately those things will adjust. But in the medium term, I think that there'll be new inventions that are coming about that we haven't yet seen. And I think all of us will be learning how to incorporate this in a tool, just like we've learned to incorporate all the other technology.
In so in ter- so a lower wages at least initially for the short to medium term, and then the further out we go in the future, it's sort of unknowable. It's really hard to predict things, especially about the future, as the quip goes. How would you compare this to the I guess the invention or the real adoption of the internet, which I guess came in, when we came of age, sort of in the 90s, in terms of magnitude and impact? I mean, I think the internet probably, I don't know if I can't remember if it lowered wages initially, but how would you compare the internet versus AI in terms of magnitude and in terms of how much impact it'll have on economies?
Similar. So I think if you take the really broad view, if you look at what productivity was or economic development when when first European settlers came into this country, the early 18th century, maybe some people here late 17th century, the overall level of economic development wasn't that different than what it had been 2000 years before. So if you chart productivity, it's sort of like this, like this, like this for thousands of years. And then it begins to go like that. And it begins to go like that because of a series of inventions. Canals changed transportation, then railroads do, then combustion engines, then electrification, then beginning to use computers, and then the internet. So there's been a couple of main waves of it. As far as we can tell, this one right here seems every bit as significant as those other waves in terms of how it changes productivity, output per person, and also how much capital spending is being used to create it when you measure it as a percentage of GDP. These measures aren't precise, but it seems roughly similar, and I don't see any reason to think that the change in how we all live won't be similarly large. So it's interesting if you look at studies of how society changed once railroads were introduced. It really changed people's whole frame of mind. For instance, most people didn't use wristwatches or any form of clocks until railroads came along. And the reason was there was no use for it. They were just guiding by the sun. Everybody was in agricultural. Now, all of a sudden, there was a train that came at a set time. You needed to know when that time was, and it changed things. People also didn't have a sense of speed because everything that they were seeing, their reference point was mostly foot traffic or horses. And so many people were killed on the tracks of trains because when the railroad tracks were better than muddy roads. So farmers would use them to walk on. But then when a train is coming, they wouldn't get out of the way fast enough because they didn't know anything could move that quickly. So I think AI is also changing our frame of reference. And how do you figure out something that's true? So when I'm researching things for AI, I know it can give me a first draft, but I also know that many of the things that are going to be wrong. And so how do you triangulate that? There are all those changes that we're working through.
That's actually a very good point. I realized that for the show that I do, one day I wanted to take a look and see what the average weighted duration of U.S. Treasury issuance was. Not long ago, that would have taken me a really, really long time. I used Perplexity, and it took me, it took them a minute maybe to put it in a chart, and I kind of knew what it was. So it said something about somewhere like around 6 years. I'm like, that's about right. I don't really have to drill too much further. If they'd said 15, I'd be, let's try that again. I don't think it's 15, but it was remarkable. Hours to a minute. But you had to know, you had to have a basis of knowledge that it wasn't completely off the wall. And I want to get to a lot of other things, but one more thing on AI. I interviewed a gentleman named James Rickards recently. He's an author. He advises the intelligence community, and in one of his books, he sketched out a financial crisis that was driven by AI. Essentially, they AI'd a fake news conference by the Fed chair who happened to be in transit and couldn't refute it. And then with all the systematic sort of ordering in the dark pools, people manufactured a financial crisis. And for someone who was on the sell side, who's traded before, that was scary. You could see that happening. Do you see the sort of the dark side of AI where people could use it to potentially do some very nefarious things?
Absolutely. First of all, it's a very clever plot line that he came up with. That's interesting. Um, yeah, I think that one of the people who won the Nobel Prize for doing the initial scientific work on AI, Sir Geoffrey Hinton, has made the same point, which I think is right, which is that people are people. We Through all these thousands of years, we haven't changed fundamentally. And so I do think that financial fraud is going to be way more sophisticated than it had been. For instance, you and I are talking now. Okay, so some of the banks use voices to recognize things. So are they going to duplicate your voice and then try to guess which bank you use and hack in? I think that all that stuff is potentially possible. And so there'll be this fight, as always, for the technologies that are going to be used more for good or more for evil. Are you use atomic energy to create green energy, or are you use it to just kill people? It's these same moral questions repeat. And the same moral issues that we've been faced with really haven't shifted ever.
That is true. That is true. But now I do want to get to something that I think is very, very important. You could say, and without going deeply into politics, that's perhaps for another show, that what's happened in the past less than a year has really changed how our allies and foreign investors look at the United States. There's a columnist at Bloomberg, Andreas Kluth, who I think is actually better in Europe, writing about Europe than writing about the U.S. But he says no one will ever look at the Americans the same way again, which is ever is a long time and subject for something else. But what I'm really concerned about is U.S. capital markets. We have a tremendous amount of run a big deficit. We have a lot of debt. We have to keep funding that. So the question is, you can say that certain people have argued that and foreign investors are dissuaded from investing in U.S. markets. What does that mean for can we fund our debt if they decide to step away? And so I just wanted your thoughts on that, because ultimately I think we are the largest capital market in the world by magnitudes, do you, whether or not you like the United States, do you ultimately say, you know what, I want a safe return on my money? I might not like the Americans, but I've got to invest there. How do you think that's going to play out?
This is it's an important question. And you're right that factually, to keep the dollar stable where it is right now, the US needs to import about $1 trillion of capital a year, which is a lot. It means the savings of people in Europe, in Asia, in Latin America, a big percentage of it needs to leave those areas and come here. And to the degree that they save, they still save some of their money in the United States, but they save any less if they, over the next 12 months, if they save 800 billion in the US dollar assets as opposed to $1 trillion, the dollar's going to go down a lot. So it's a tough thing to want to it's tough to imagine even more money coming here given that pressure. On the other hand, this is very different. If you look at past times when currency systems broke down, like for instance, when the British Empire began to weaken, there was a ready alternative, which was the United States. It's harder now to see the alternative. And these things that we were talking about a moment ago, the AI, the epicenter, well, there are great AI companies all over the world. The epicenter of it is in the United States. And the only explanation I have for how well the dollar has held up, despite the obvious erosion of institutional norms, is that global investors are so far saying they want to put their money in those tech companies in the United States, and that offers a major buffer, slowing the dollar's decline.
If we look at I took a look at a chart of the dollar, just a DXY because it's the easiest one to chart. Um,
Yep.
uh, the dollar, if you look back over decades, is about sort of in the middle of really dead in the middle of the range. And I know that if you had to hedge the dollar, it's your returns have been flat or negative. Although that might help if our short-term rates start to come down dramatically. If the Fed cuts 150 basis points, then you can probably hedge your exposure short-term, your dollar exposure short-term. So if the dollar were to go down another 10, 15%, what that ought to, in some ways, make U.S. debt more attractive because you're
Correct.
um,
Foreign investors, that's right. And then one note on looking at the dollar, I find it very helpful to make two adjustments when looking at those charts. The first thing is to adjust it for inflation.
Mm.
And the second thing is to adjust it for uh, purchasing power. And if you make those adjustments, you'll see that the dollar is about as expensive as it's ever been since the breakup of Bretton Woods. So that makes the argument even more challenging. For the dollar to go up from here, you really have to see extraordinary inflows coming into the United States.
Um, I one thing that I remember very well, the sort of about a dozen or so years ago when Europe almost came apart. You can argue that Mario Draghi saved the European Union, but if you look at 10-year yields now, just to pick a benchmark, right? All the pigs countries, so to speak, Portugal, Ireland, Italy, Greece, Spain. The 10 years are all yielding below the US. I mean, I think Greece is 60 basis points below the US on the 10-year. So how would you look at it? Would you say that there is so much risk and so much debt in the U.S. that U.S. 10 years are actually higher than all the PIGS countries? Um, or is it something like, if inflation and bond yields are all coming down, Greece was unbuyable in 2012, 2013, and well, apparently no longer so, although you could argue that maybe a lot of their local banks have bought their debt. But
Right.
The U.S. versus Greece, a premium of 60 basis points. I mean, eventually somebody's going to figure out I would rather have U.S. debt than Greece debt.
Does
Yeah,
that
I
seem
think that's right. And that's been what's going on. So despite the fact that the US has gigantic fiscal deficit and the fact that there is this erosion of institutions, US bond yields have fallen this year. They've fallen about 40 basis points, which is telling you that there's a very simple but true thing. There's more demand than there is supply. So I believe that that can continue. And particularly if the AI creates more deflation than people are expecting, then the bond yields, which is against what many people are thinking is likely, could actually fall from here as opposed to rise. And the relative comparison to other countries matters, that a lot of these developed. If you look at, for instance, real yields in the United States compared to real yields in Germany or Japan, they're incredibly attractive. And I think that that's also one of those factors that's been getting money in the United States, keeping the dollar stable and driving those yields lower, as well as equity prices higher.
You did write that inflation and bond yields have further to fall. Are we sort of back into that 2008 to maybe 2020 pre-pandemic, where every time there was a pop in bond yields, you would buy bonds? Are we back in that paradigm? Because the fear was, and we're in a new paradigm of sort of higher inflation, due to, in some ways, people argued green energy. Right, green energy is a lot more expensive. If the rest of the world continues to pursue that, and ultimately the U.S. does that, are we back? Are we back in the old paradigm, or are we in a new one, or something in between?
I try to, as an investor, I try to take things more week to week and month to month and make grand claims about paradigms. And I think for now, that's where the force of pressures is, because what's happened was we got the pandemic inflation. Bond yields rose so much that the only people that were borrowing was the government. Private sector borrowing is very, very weak. And it's the netting of those two forces, the private sector and the public sector, that creates the yields and the bonds that people then use to borrow and spend on mortgages. So for those yields to continue to come down, what you would have to see is the saving we've seen, but not a strong response from the private sector. So if 10-year bond yields get into the 3% range, mortgage rates will begin to come down. How confident are people about their economic earnings prospects that you're going to see a big increase in borrowing? I don't know. And that will determine which era we're in. If you still see reluctance on the part of the private sector to borrow, maybe because they remember what happened in 2008, then yes, it's possible for them to come down. And it also matters tariff policy. So tariff policy is basically a huge tax increase. The White House has so far lost two court cases about the legality of their policy decision. If they lose the Supreme Court decision, then they will, of course, use different rationale for introducing tariffs under a different legal basis, but it would weaken those inflows, some that are coming from the high tariffs. So these are all factors that I like to assess more week to week and month to month than with the assurity that this is how it'll play out over the next 10 years.
It's a little bit of a tough call in terms of if the Supreme, it looks like the Supreme Court's going to take the case in November, argue the case in November, and perhaps a decision before the end of the year. But if they were, I suppose, if they were ruled illegal, you have a lot of volatility in the beginning of 2026 as they try to redo this, which may not be good for the economy, but may be good for discretionary macro hedge funds.
Yes, exactly. So a lot of these changes that are underway are exactly what macro was created for. And so for me, it's do I think that the earnings of these tech companies are going to be good? I do, if we don't get a currency crisis. And if it's just a straight tech hedge fund, they're just going to own tech, and that's that. If it does well, you do well, and if it doesn't, you don't. But the wonderful thing about macro investing, from my perspective, is that you can combine investments. You can combine a long investment in tech with a short position in the dollar. And it's sort of like having a house, but also having an insurance policy on the house in case it burns down.
If I might ask, for for somebody who's discretionary macro, do you benchmark yourself? Does Kate benchmark itself to something, or is that just too difficult in terms of who do you benchmark yourself to?
It's just absolute return. The idea is to give people, steady returns over time. Once you introduce a benchmark, like you say, oh, you're supposed to outperform stocks, you're supposed to outperform bonds. The first thing that a manager will do is buy that benchmark. And then they'll take their positions relative to that. And the whole point about macro is that sometimes, there's in 2022, the last thing you wanted to do was be benchmarked to bonds. You just wanted to short, short, short. in the first half of this year, you did not want to be benchmarked to stocks. You just wanted the ability to short them to benefit from price declines.
I want to switch gears a little bit. You were very deep into China, certainly a China expert. And what we've seen in China, and I watched the benchmark, and it's gotten back up to about the level where it was when they had the big stimulus in late September of last year. But my thinking there is, has China reached the end of its or close to the end of its potential as a market economy run by a very, very authoritarian government? President Xi has clamped down on some of the, over the past few years, has clamped down on some of the fastest growing parts of the economy. They've had a tremendous deflation in their version of PPI, which is shocking. How can prices keep going down for however many dozens of months? Crush the animal spirits. What are the opportunities in China now, short to medium term?
I think that there's sort of three things going on in China. The first thing, you're right, is that just like there's a Mag 7 in the United States, there's a Mag 7 or Mag 10 in China. The difference is notwithstanding the rally you're talking about, the discounted forward earnings growth of those companies are a fraction that of the US, meaning that they don't have to do nearly as well as the US for you to do well as an investor. That's one thing that's going on. At the same time, China is experiencing a deflationary deleveraging, just like what happened to Japan in the 1990s and what happened in the United States in 2008. The key thing in those situations is to stimulate and stimulate heavily, which the Chinese aren't doing, which is why you're seeing the deflation. And then the last thing is that China's political system is authoritarian. It swings between more reformist like Deng Xiaoping and more conservative like Mao. And Xi is definitely on the spectrum of more like Mao. And that's part of the reason why the equities trade at such a discount. And so when you're deciding to buy or sell in China, you really need to properly weigh those three forces. What is the earnings potential of these companies? I think it's pretty good. What is the power of the deflation? That's a negative. And what is the power of the authoritarian crackdown? That's also a negative. Recently the stocks had done well, and they issued an edict that they didn't want the stocks to go up so quickly. The stocks sold off overnight. I mean, that's a very Chinese type of thing to have happen.
So it sounds like from your answer is the if it came to a point where China actually, and it's amazing that that their government is very fiscally conservative compared to everybody in the West, remarkable in some ways. But if they decide, we're really going to stimulate that, that might be a signal that you want to sort of close your eyes and buy.
Well, yeah, I think that again, these decisions are always so tricky to weigh off the pros and the cons. But again, there's a much weaker expected earnings growth there, so you've got more of a buffer if you own assets there. But certainly, if they began to stimulate in the way you're describing, then I think that the stock market could really rip. But different central banks have different independence. I think based on the merits of the economy, the central bank ought to be stimulating there. But the People's Bank of China is not independent. It's a political organization, and they're being given guidance not to stimulate. And so that slows down that whole recovery, and it puts a limit on how much the equities can move.
What's interesting is I see them. There's like, they've cut another 10 basis points or 25 basis points on one of their lending rates. And the view is, well, you're in the middle of a deflationary spiral. That's not going to make somebody who's worried about the future. Your 25 basis points, not going to want to make them borrow or expand unless you give them hope in the future that it's going to be better. And it seems like maybe they haven't quite learned that lesson yet.
Well, I think first of all, they use many different tools this is one of the reasons China is so complicated. The Federal Reserve has one tool, which is to raise or lower interest rates. The People's Bank of China and Chinese regulators have many, many, many tools they can use. So they could lower rates by a little bit, but then they could call up banks and tell them to lend. And so it's almost has the same effect. And to really figure out what's going on, you need to calibrate all of those different moving parts. But I think that the political overlay from this is that she sees using those techniques as irresponsible. And I don't think that that's accurate, but that's what his view is. And it's similar to what the Japanese thought for many, many years. And it was only after Ben Bernanke began using those tools in the United States that the Japanese, so that was almost 20 years into their crash, began to really aggressively use those same tools.
Final market I want to get into is crypto. Um, Crypto, it seems to me crypto is stocks plus some sort of beta depending on the day. And if some of these treasury companies are buying now, it's not just Bitcoin. Some are stockpiling Ether. I think somebody came out the other day and said, what is it? I can't remember the name. 8 something or other. They're going to stockpile WorldCoin, and the thing went up 3,000%. What do you? It did. It was amazing. It went up 6,000% and finished up 3,000%. It was quite remarkable. This WorldCoin idea seems to be pretty interesting. It's from Sam Altman, and they look at you. They take a picture of your iris, and it creates an identity, and you get a coin. And I haven't done enough research, but in terms of the whole crypto complex, your thoughts on how you would invest in it, and I know you sometimes you look weeks to months, but any thoughts about that going forward?
I think that there's the kernel of a good idea there, and then there's also a lot of fraud. Bitcoin itself, to take the simplest thing, is basically another form of gold. And my view on it changed when I looked at the use that it could have, particularly for people in countries with terrible monetary systems. So a very concrete example of that is after the war in Ukraine, many Russians fled because they didn't want to participate in the war, fighting edge men. And some of them, for instance, were in Argentina. So they still had jobs, remote jobs, they were programmers, et cetera, that paid them in rubles, which is a sanctioned currency. And they also have terrible inflation. And they were living in Argentina, particularly pre-Milei, and inflation was out of control. Inflation is so high, but it's not as out of control. In the past, they literally would have had no opportunities. And what Bitcoin allowed them to do was actually, it was a little bit like cell phones replacing landline technology. In Russia, online, they could sell rubles and buy Bitcoin. And then in Argentina, they could sell Bitcoin to buy pesos to get their groceries. So that was a very practical, legal use of Bitcoin. And I think that that changes what its use is. And if you think about the population of the world, the vast majority of it lives in places with bad monetary policy regimes. And so crypto is a way of giving them some autonomy from that. If you are in places in Africa or Latin America, other places where you're not confident with and for some Americans, it's in the United States, you're not confident in the authorities' ability to do that. If the Fed loses more independence, Bitcoin is much more easy to transact in than gold. Like if they wanted to do that same trade, sell their rubles for gold and sell the gold for pesos, that's harder to do. So I think that's the pro case for Bitcoin. The con is that there's obviously a lot of hype around this, and there is a lot of use of it for fraud. And I think it's, an asset that goes up 3,000% in a day. It's too volatile to be a useful medium of exchange. So that's just raw speculation. So I think you need to distinguish which part of it is real and actually has a productive use as a money transfer mechanism, and which part of it is fraud.
That's a fascinating story about Russian programmers in Argentina, because what we don't see here, and because we have a stable monetary system, is very rarely do you say you can see this item costs $49, or the 0.000 equivalent in Bitcoin. You don't
Right.
see that here, but from that it sounds like that in certain places that that don't have stable monetary regimes, that that is happening and may continue to grow over time.
Yes, exactly. And I think it will. And it'll be, like I said, like cell phone technology. Like a lot of these places had terrible telephone systems, and it was very cumbersome to build the poles and the lines. And then cell phones came along, and you could just install towers, and the whole society leapfrogged. And now everybody in the world has a cell phone. So I think that for many places, in a way, it sort of allows them to outsource their central banking to some sort of tech thing that has real limitations. Like, to be clear, the ability to expand and contract the money supply is critical to maintaining wealth. Bitcoin does not have that. So it's a more primitive source of money. But it all depends on what the alternatives are. Our whole conversation is what are the alternatives? And that's, again, the message for the uncomfortable truth about money is that there is no reliable source of money that exists in the world. And so one of our jobs as adults is to try to make the least worst choices to find our path.
You wrote a book about money, as I recall.
Yes.
Eddie, what was if you had to give the audience one lesson about money, whether to think about it, to invest or whatever, the one lesson, what would it be?
From your book.
It's the headline. The uncomfortable truth about money is exactly that, which is that we all need money. It's essential, but the thing we want from it, which is stability and an ability to grow, no form of money will give you. Doesn't exist. So this is a paradox that we have to live with as adults, which is you'd like your money, your savings to grow faster than inflation, but you can't trust a stock or a bond or Bitcoin or gold or anything to give you that guarantee. It's always uncertain. So it's about how do we learn to think for ourselves in this? And I think it requires a little bit of education, just like we learn ultimately about how to eat well or sleep well or any of these basic life skills that aren't really taught in school. We're forced to learn it. It's like with money, you've got to deal with the physics of that reality and come up with some sort of plan that's appropriate to you personally.
Final question of the of our hour. As a hedge fund manager, I'm sure leverage is very important, how you use it and how you think about it. How would you take that lesson to say we have a lot of individual investors who, in the US and Korea who do a lot of investing. Any lessons you want to say about when to use leverage, when to dial back on it, when to really increase it? Because if you're right and you're levered, it's great. But certainly the flip side is also true.
Yes. I think leverage is, the way I say it is, leverage is like electricity. That electricity is a fantastic thing. It's allowing us to have this conversation. But it's also true that if you put your finger in the light socket, you die. So that's leverage. And the way I think it can be useful is that is in the pursuit of diversification in a portfolio. So there can be assets that can be good investments, but their native volatility is very, very low. So for instance, if you are investing in 2-year bonds as opposed to 30-year bonds, 2-year bonds are not very volatile. 30-year bonds are. 30-year bonds have a similar volatility to stocks. So with the 2-year bonds, if you want to make them equivalent in risk to your 30-year bonds or your stocks, then you would have to use some leverage. Now, if those 2-year bonds are diversifying relative to the other things, then it can be good use of it. If you take something that's already crazy, crazy volatile, like copper or Bitcoin or any of these types of things, and you add leverage to that, it can really wipe you out. If anything, with investments like that, I think about how to de-lever them. So if you held, as opposed to $100 of copper, you held $50 of cash and $50 of copper. Now you've got copper, but it's much less volatile.
That's a great way of thinking about it. Actually, you should lever up the things that are not that volatile, because if you have a good idea in them, and to enhance your returns. But maybe the triple micro strategy or strategy ETF may be a little unnecessary.
Yes.
certainly, I don't think I'd sleep at all ever, holding a triple MicroStrategy ETF. Thank you very much for your time today. That was really, really useful insights. It gives us a lot to think about, a lot to when we look at how we look at our investments and look at the world overall. So I look forward to future conversation. Thanks again.
Great. Thanks so much. Nice chatting to you as well.